Hey guys, RC Peck here with Fearless Wealth. I've been getting a lot of questions around is this the bottom? Like, is this the bottom? Is this the bottom? Is this 87? Is this '08? Is this 2000? And the first thing my brain does when people ask me that question is I go to what I call divergence indicators. And I have a handful of divergence indicators that I look at that historically they have to be above a certain point to say, probability says the bottom is in. And so it helps to look at those and to see what they're telling us about the bottom. Is this the bottom? Is this not the bottom? So what I'm going to do is get behind the computer and look at those divergence indicators and see what they are telling us about the bottom. And is this more like an 87 or an '08 or a 2000 or no one really remembers 1974? To go ahead and look at that. So give me a second. Let me get behind the computer and let's look at those divergence indicators. All right, thanks guys. Give me a second. All right, guys. This this chart looks kind of crazy, I know. So on every chart we look at, the top of the chart is going to be an indicator that I'm talking to you about. And we're going to talk about all similar type of indicators, which are commonly called breadth indicators. And the bottom of the chart's always going to be the S&P 500. I think it's always SPY, but it'll always be the stock market. So we're going to go through 4 or 5 of these indicators. So this one is the New York Stock Exchange common stock only. So this is common stocks. This is stocks in the New York Stock NYSE index. And basically this measures what stocks are at new highs, right? So we want to know what stocks are at new highs. And you can see it's hard to decipher first time looking, but when the market goes through a correction, which just was 2015, what happens is the new highs drop below here, right? They bounce up and down, but they stay below the screen line. Here in Q4 2018, again, we are bouncing below here too. And then here we have the Corona crash right here, and it's down below. So let me do this. Let me just zoom in to the most recent one. So again, this is the same indicator. We're looking at New York Stock Exchange stocks. And when they're below this, that means not enough of them are making new highs. And as you can see, it fluctuates up here, and that's a healthy market. So on this indicator, we want to see stocks as a collective group get above this 20 line, right? And that's going to be an indicator to us that, yes, strength has come back to the market. Okay, so that's one. And you just call that the New York Stock Exchange new highs. Now this, okay, is the new lows. So it's just the flip of what we're looking at. We want this to drop. As you can see, all these spikes right here. This is 2015. This is Q4 18, right? And this is where we are right now. You can see when the market is falling, crashing, new lows spike. Now we'll have more spiking as the market falls. Okay, so let's zoom in on this. Again, so this is new lows. Now this one has dipped below, which makes sense, right? Because it means fewer stocks are making new lows, right? So that means there's been some sort of stabilizing, right? And this one's been a little bit of a divergence because if you look up here to the actual indicator, it peaked on March 12th. Well, March 12th is right there, but then the market continued falling, right? So the price kept falling even though fewer stocks were making new lows, which means the stocks that were already hitting new lows were just getting weaker and weaker, right? Because we're looking at the number of stocks, not how far they're falling. So for this one, how many stocks are making new lows? This has dropped, and this is a positive sign that possibly the peak on the amount of stocks making new lows happened on March 12th. So this is one indicator. Now, look, guys, this has got to stay down here, all right? And what's interesting is even if this doesn't peak above, you still could have many stocks continuing to weaken, right? But there wouldn't be more of the stocks. It would be the same stocks just getting weaker and weaker. So this typically, don't be surprised if this is one of the first indicators you see that starts to look healthy, which it is. There's a little bit of a divergence here, which is it's good news. Okay, this indicator right here, this is the third indicator we're looking at. This is how many stocks in the S&P are above their 200-day moving average. Now, a 200-day moving average is just the closing price of the last 200 days plotted on a line. So all this indicator wants to know is how many stocks in the S&P are above its 200-day moving average. And back here again in the 2015 correction, you saw this line drop, right? And it hovered kind of around the 20, right? And then here in the Q4 2018 correction, again, the same thing. It broke below this 20. I guess it's really about 21-ish. And then with the Corona, it's broken below. So what we want to see is this to move clearly above this line. It's not the break below and then the bottoming. It's that we want it to go back up. And so as we zoom into this, we want to see this line get above the black horizontal, right? We want to see stocks get above their 200-day moving average. Now that's going to be a slower indicator than stocks getting above their 50-day moving average, right? Now, this is zoomed back a little bit more. This is the 2015 correction. This is the Q4 18 correction. This is the Corona one right here. And because this one was zoomed back more, this is the debt ceiling debacle back in 2011, which just was a 20% correction. To give you an idea of how scary that was, if people don't remember, it was not even a 20% correction, but look how many stocks, there are almost no stocks above their 50-day moving average. That's how scary this correction was, even though it was less than 20%. Now, guys, look, I don't want to overwhelm you. It's kind of fun to entertain, but if you're noticing yourself, look, I know I can be better. If I trained my brain, if I trained my money, I know I could be better at managing this. And I'm not talking about 2 hours a night, right? More effort does not create better returns. Buying one sector that's trending higher and doing that right is a heck of a lot less effort than buying 10 different sectors or 10 different symbols that are going sideways or down. So I often find that if you are trained to do the right thing, you actually have a lot more time on your hand. And I do have a training. And so if you find yourself interested in being better wherever you are, in being a better steward, and having control back over your money, which is what a lot of people say, look, I just want to have control back over, then go ahead and click the link below or in the outro, and you can learn about the training. Okay, so this one is a faster indicator because this is just the 50-day moving average. So how many stocks are above or below their 50-day moving average? So now let's zoom into this. So as you can see, there's still not a lot of stocks above their 50-day moving average. Now, it's a heck of a lot easier to get above your 50-day than your 200-day. But as you can see, it's still not turning up. Interesting, it did pop above here once at the beginning of the correction and then it came down. But look at this, that's 1.2. That's 1.2% of stocks in the S&P above their 50-day moving average. So we need to wait for that to turn around. And then I got one more for you. This is the advanced decline line. How many stocks are advancing? How many are declining in the New York Stock Exchange? This doesn't have quite the put in a horizontal line and have it break above or below. This is more of the above chart. This is the advanced decline line. It's really about breaking above a resistance point. And it's not even as simple as just breaking above that, because I know this is super small here, but you had to have this break above a lot of horizontal resistance right there. But nonetheless, let's zoom into this and just look at what the advanced decline line is doing. And it is bottoming just like it bottomed here. Now, the big question everyone has is the bottom in? And you want to lean towards the weight of evidence, right? What is the evidence saying? And I lost count. I think I just showed you 5 what I call divergence indicators, or did we bottom indicators. And of the 5, maybe only 1 said that, yeah, maybe this is. What it seems very likely is for sure this is a short-term bottom, right? The price, a lot of buyers came in at the Q4 2018 low for the S&P 500. So this is one way. So if you're following people that are day traders or week traders or short-term traders, for them, what they'll probably say is the bottom's in, because their perspective is days and maybe weeks. If you are a long-term investor, which in many ways we all are, and that's how you want to behave, listening to someone who thinks in hours or days or weeks might not actually help you, right? Because if you're thinking in years and decades, yeah, a bottom may be in right now, but what they're really saying is a short-term bottom or a tradable bottom. And I believe what most people want to know is the bottom in? And so if you haven't, go look at the other video I did on comparing this correction to the 2008 one and the 2001. Hey guys, thank you for being in my world. If you have questions, go ahead and put them down in the comments. Go ahead and subscribe so I can grow the channel and give you more and more information. Let me know what you like and what you don't like, what you agree with and what you don't agree with, and be constructive so we can learn from this and I can give you more of what you want. All right, guys, this is RC Peck. And thank you so much for being in my world, and I'll talk to you guys soon.